If you look at the charts right now during the Asian trading session, specifically the Singapore dollar against the US dollar, everything looks almost suspiciously calm.
It really does. It's just flat.
The pair is hovering right around 1.3012, barely moving, just flatlining.
Yeah.
To a casual observer, it looks like a standard, a boring day of market consolidation.
Exactly. Nothing to see here.
But that stillness is deceptive. It's actually the entire global market holding its collective breath. Underneath that flat line, a massive political storm is brewing in Washington that directly threatens the stability of the US dollar.
And this isn't about the usual economic data releases, is it? We're talking about something far more fundamental.
We aren't just looking at standard economic indicators anymore. We are looking at a timeline that feels less like finance and more like a political thriller.
I think that's the perfect way to describe it.
You have Treasury Secretary Scott Bessent dropping hints that President Trump might announce a replacement for Federal Reserve Chair Jerome Powell before Christmas. Just imagine the scene for a moment.
The timing is just extraordinary, right in the middle of the holidays.
Exactly. The markets are trying to navigate the thinnest liquidity of the year, and meanwhile, the most powerful central banker in the world is effectively being shown the door. And the name that's circulating, Kevin Hassett, that changes everything.
It's not just a name, it's a signal. A huge one.
The market realizes that this isn't just a personnel swap. It's a potential regime change toward aggressively loose money and slashed rates.
A complete philosophical shift, potentially.
So while that 1.30112 number looks stable on your screen, it's actually a fragile standoff. The market is paralyzed, waiting to see if a Christmas announcement is going to pull the rug out from under the US dollar completely.
And that's the standoff we're here to talk about.
That is the standoff, and that is what we are deep diving into today. The convergence of US political drama, the potential erosion of the Fed's independence, and its immediate structural impact on Asian financial stability, perfectly exemplified by this USDSGD standoff.
It's the highest stakes game of chicken the market can play, really, because the underlying issue here is institutional integrity. It's about trust.
Trust in what, specifically?
Well, on one hand, you have the Federal Reserve, the linchpin of global finance, which operates entirely on the perception of objectivity. On the other, you have a potent political desire for immediate short-term economic stimulus through forcefully lower rates.
And the fear is that one is about to completely override the other.
Precisely. If that objectivity is breached, the consequences are global and they are lasting. This isn't something you can just walk back a month later.
Okay, let's unpack this political firestorm. We have to start with the source of this tension, which is, as you said, the possibility of the Federal Reserve being openly politicized. When we talk about institutional erosion, what specifically are the markets reacting to regarding the selection of a new chair? Why is this particular nomination causing such profound anxiety?
The anxiety is driven by the very high probability of a specific outcome, the nomination of Kevin Hassett. It's not just a vague fear. It's focused on one person.
And who is Kevin Hassett, for those who might not be following this as closely?
Hassett is currently the director of the National Economic Council, so he's already a very senior figure. But he is viewed by the market as someone who aligns very, very closely with the administration's preference for aggressively lower interest rates.
So he's seen as a loyalist.
He's seen as dovish. We've seen him consistently argue that the economy can handle much lower rates without triggering inflation. He's essentially dismissing the standard Phillips curve relationship that the current Fed relies on.
Which is the classic trade-off between unemployment and inflation.
Exactly. Yeah. His public commentary paints him as far more dovish, prioritizing growth and employment stimulation over inflation control than any recent Fed chair we've seen.
But the Fed chair position is always political to some extent, right? I mean, they are appointed by the president. They go through a political confirmation. What makes the Hassett probability feel different, almost like a certainty that bypasses those traditional checks and balances?
It's the speed and the signaling. The view that Hassett will replace Powell firmed up so dramatically after news emerged that interviews for other top finalists, like Christopher Waller, were abruptly canceled.
And Waller is a sitting Fed governor, so he would be considered a more traditional and institutional choice.
A very traditional choice. He was supposedly meeting with Vice President Vance, and that meeting was just scrubbed without explanation. The market immediately read this as a massive signal that the president had already made up his mind.
The decision was already made behind closed doors.
That's how the market interpreted it, and you can see it in the numbers. Just a few weeks ago, the betting markets had Hassett's and Waller's probabilities as roughly equal, maybe around 35% each.
A coin toss, basically.
Pretty much. But when that interview was canceled, Hassett's probability just shot up to 85%.
85, that's huge.
That 85% isn't just a number. It reflects the conviction that the internal political process has concluded, and only an external force, perhaps a legal challenge or some kind of financial turmoil, could halt the decision now. That dramatic jump is what solidified what traders immediately labeled the Hassett Trade.
Wait a minute, 85% is nearly certain. And given the historical difficulty of predicting Fed shares and the complex Senate confirmation process, what specific pieces of information beyond a single canceled interview could possibly justify that extreme conviction? Are we, falling victim to recency bias here, or is there genuine data supporting this near certainty?
That's an excellent critical question. And no, it's not just the canceled interview. The conviction stems from the timing and the political framing of the entire narrative.
What do you mean by the framing?
The administration has repeatedly used public statements to pressure the Fed for months, for years even. The replacement narrative has been very tightly managed to suggest that a political corrective action is necessary to fix a policy error.
So it's being sold as a necessary fix, not a political power grab.
Exactly. Furthermore, the market is recognizing the president's willingness to push the limits of executive power, something that, frankly, wasn't priced in during previous administrations. So when the president signals a decision is imminent before Christmas, it suggests they are trying to rush the process.
Why the rush?
To get ahead of the market's reaction, to do it before the market fully digests the implications and before any kind of legislative resistance can consolidate in the Senate. In political markets, that kind of speed equals certainty.
Right. And the markets gave us a kind of mini preview of what this trade looks like the moment Hassett was put firmly in play.
Yeah.
If someone out there is executing the Hassett trade, what exactly are they buying and selling?
Well, the trade is fundamentally a bet against the US dollar. It's as simple as that at its core. If you anticipate a highly dovish Fed that's going to prioritize growth by aggressively cutting rates, you are essentially pricing in a lower future yield for US assets. That makes the dollar less attractive to hold globally. So the immediate reaction, that mini preview you mentioned, was a weakening dollar across the board against almost all major currency pairs.
So dollar down, what else?
Beyond the currency impact, we saw a reaction in the bond market. There was some modest bullish steepening of the yield curve.
Okay, break that down for us. Bullish steepening.
Right. So steepening means that the spread, the gap between short-term interest rates like 2-year treasuries and long-term rates like 10-year or 30-year treasuries gets wider.
Okay.
Bullish steepening suggests that investors anticipate the short end of the curve, which the Fed directly controls, will fall rapidly due to those aggressive rate cuts. But at the same time, the long end holds firm or maybe even rises slightly.
Why would the long end hold firm if rates are falling? That seems counterintuitive.
It does, but it's because of the political risk we just discussed. It's about credibility. If the Fed is perceived as abandoning its inflation mandate for political reasons, investors who are lending money to the government for 10 or 30 years require a higher inflation risk premium to hold that long-dated debt.
They're afraid their money will be worth less when they get it back in 30 years.
Precisely. So the short end dives on Hassett's dovishness, but the long end faces upward pressure due to that institutional credibility risk. And then finally, the third piece of the trade. Risk assets, equities, commodities, even cryptocurrencies, they all turned gently did.
Meaning they went up.
They started to rise, pricing in the prospect of cheaper money flooding the system and fueling asset purchases.
But I've heard some pushback on that immediate dollar weakness, particularly among more sophisticated investors. I've seen reports of buy-side customers saying, we should fade this move. That means betting against the immediate dollar crash. Why would they be skeptical that Hassett can be that dovish, even if he wants to be?
That skepticism is, it's rooted in the structure of the Federal Reserve itself, specifically the Federal Open Market Committee, or FOMC, and its voting process.
The committee that actually sets the rates.
Right. And even if Hassett becomes the chair, he is not a monarch. He's a very powerful voice, but he commands only one vote out of 12.
Okay, so tell us more about those 12 votes. It's not always the same 12 people sitting around the table, is it?
No, absolutely not. It's a carefully structured system designed specifically to dilute centralized power and to bring in diverse perspectives.
How is it structured?
The FOMC consists of 12 voting members. The 7 members of the Board of Governors in Washington, that includes the chair, the vice chair, and 5 others, plus the president of the Federal Reserve Bank of New York, who has a permanent vote.
So that's 8 permanent votes.
8 permanent votes, correct? And then you have 4 rotating presidents from the other 11 regional Fed banks. These regional bank presidents rotate their voting seats annually.
So there's always fresh blood, so to speak.
Exactly. And the buy-side argument is this. Hassett would take over a committee that already has established non-political members. Even if the other 6 governors are eventually replaced with politically aligned appointments, a process that takes a lot of time and requires Senate approval, the 4 rotating regional bank presidents often maintain a very strong, independent, data-driven perspective.
Who are these regional presidents, typically?
These are people like the presidents of the Cleveland Fed or the Dallas Fed or the Kansas City Fed. They're typically professional economists who are deeply invested in monetary orthodoxy and inflation control. They represent distinct regional economies, and they have a deeply established institutional culture of consensus and independence.
So the bet is on the institution being stronger than the individual.
That's the bet. Some large customers are betting that even a politically aligned chair would struggle to push the entire committee toward radically aggressive rate cuts if the underlying economic data doesn't support it, or if inflation expectations become dangerously unanchored. The institutional friction of the FOMC process itself acts as a brake on any single political actor.
That brings us right to the core issue of why independence is so paramount. Why does the world care so profoundly who chairs the Fed? Why is central bank independence critical, not just for the U.S., but for global financial stability?
Well, the independence of the Fed, its operational autonomy to set interest rates without immediate political interference, provides the very bedrock for global finance. When the Fed acts, the market has to believe its sole focus is on its dual mandate: price stability and maximum employment.
Not a political mandate.
Not a political mandate. And this credibility ensures confidence among buyers of U.S. Treasury securities, both foreign central banks and domestic investors. They are buying the U.S. promise to pay back its debt.
The famous full faith in credit.
Exactly. And they need to trust that the value of the dollar they are repaid in won't be eroded by politically convenient inflation down the road. If investors trust the Fed is focused on the long term, it dampens interest rate volatility, particularly at the long end of the yield curve.
And if that trust erodes?
If that trust erodes, Treasury buyers demand a higher risk premium, which means higher yields, to compensate for that instability. And that is a direct negative consequence for the U.S. Treasury and for the U.S. taxpayer.
Here is where it gets truly interesting. We can actually quantify this risk. What are the specific, sobering estimates regarding the cost of politicization? What happens to the average consumer, to you, if that trust is lost?
The models are startling. They really are. Economic studies have attempted to quantify what happens when the market fundamentally believes the central bank will prioritize political expediency over price stability.
What do they show?
These estimates, which are based on historical parallels and modeling shifts in long-term inflation expectations, indicate that a loss of Fed independence, specifically the market pricing in future political interference, would cumulatively increase the Consumer Price Index, or CPI, by an alarming 11 percentage points by the end of 2028.
Hold on. An 11 percentage point cumulative increase over 5 years. That is a staggering inflation surge. How does the model even arrive at a number that high?
It's largely driven by the psychological shift of inflation expectations. You have to remember, inflation is inherently self-fulfilling.
What does that mean?
It means if bond investors, manufacturers, and workers all believe the Fed will allow inflation to run hot to stimulate the economy, they act on that belief immediately. Bond investors demand higher yields right away. Manufacturers raise their prices preemptively. Workers demand higher wages to keep up.
The inflation happens just because everyone expects it to happen.
This dynamic accelerates inflation even before the Fed actually cuts rates. The 11% figure represents the cost of permanently anchoring those expectations at a higher, less stable level due to an institutional breakdown. It's a massive inflation surge built simply on the erosion of institutional credibility.
And this isn't just theoretical. We have historical evidence of what happens when political pressure overrides policy, right? We aren't just speculating in a vacuum. The 1960s and 1970s provide a pretty grim blueprint for this.
Absolutely. Those decades serve as a stark warning about the dangers of losing independence. President Lyndon B. Johnson, who was desperate to fund the Vietnam War and his Great Society programs without raising taxes, exerted extreme pressure on the Fed chair at the time, William Martin, to keep rates low.
And there's a famous story about that, isn't there?
There is. In 1965, Johnson summoned Martin to his Texas ranch and physically bullied him. The story goes that he was leaning over him, yelling at him to keep rates down.
Wow. That is a staggering visual. The President of the United States physically intimidating the Fed chair on a ranch.
It really underscores the political intensity, and that wasn't an isolated incident. Following that, in the late 1960s and early 1970s, President Richard Nixon exerted similar pressure on Arthur Burns, who was then chair, specifically before the 1972 election, to keep monetary policy highly accommodative.
For his re-election campaign.
Yes. Nixon was recorded on tape explicitly discussing how monetary policy could aid his re-election campaign. It's all there on the public record.
And what was the result of all this interference?
It contributed directly to the period we now call the Great Inflation and the resulting stagflation, high inflation, coupled with stagnant economic growth.
The worst of both worlds.
The absolute worst. Why? Because the market lost faith that the Fed would prioritize price stability. Once the market realizes monetary policy is just a tool for driving short-term electoral growth at the expense of long-term inflation, the consequences are severe. Risk premiums increase, capital flows out, and the dollar depreciates significantly.
And it took years to fix that.
We spent a decade battling the economic consequences of that compromised independence until Paul Volcker had to step in the 1980s and raise rates to punishing levels, which triggered a very painful recession just to restore credibility.
The stakes are astronomical then. Yet the current administration seems determined to challenge this status quo. If the president wants to move the current chair, Jerome Powell, and install someone like Hassett, what legal checks are actually there on that executive power? Is it legally feasible to just fire the current chair?
Legally, the president's power to remove the board chair is highly constrained, and this is a historical consensus built over decades of practice and law.
What's the specific law?
The Federal Reserve Act of 1913 allows the president to remove the board chair for cause. And that phrase, for cause, is everything. The legal precedent that defines for cause is key, and it stems from a 1935 Supreme Court case, Humphrey's Executor v. United States. That ruling established that members of independent agencies like the Fed can only be removed for specified statutory causes.
Which are what, exactly?
Typically defined as inefficiency, neglect of duty, or malfeasance in office. Very high bars.
So does policy differences, just disagreeing on whether interest rates should be higher or lower, count as cause?
Absolutely not. Legal precedent strongly suggests that policy differences do not qualify as cause. Removing a Fed chair simply because the president disagrees with their interest rate path would represent a radical departure from historical legal understanding.
What would happen if they tried?
It would almost certainly trigger a constitutional crisis and an immediate court challenge. Now, while the Supreme Court could, theoretically, overturn legal precedent and grant the administration broad authority, that is a high-stakes, uncertain legal battle that would dominate the news cycle and spook markets even more than a simple appointment.
But the truly immediate check, the one that made the administration soften its stance the last time threats against Powell were issued, wasn't a legal one. It was the market itself. The market acted much faster than any court could.
Precisely. The financial market serves as the ultimate and most effective check on presidential monetary interference. The swift, severely negative market reaction to previous threats against Powell, a weaker dollar, dramatically higher long-end treasury yields, shunning of U.S. dollar-denominated assets, was a hint of catastrophic bond market turmoil.
So the market votes with its feet or its dollars.
Instantly. And you have to consider the current environment. The U.S. government is running massive deficits, and the Treasury needs to roll over about 30% of its maturing debt this year. That amounts to trillions of dollars.
An incredible amount of money.
It is. So if the market believes the Fed's independence is compromised, Treasury buyers, especially foreign nations like China and Japan, who hold huge amounts of this debt, will demand significantly higher yields to compensate for the newly introduced political risk.
So the president can threaten Powell, but the bond market essentially responds by saying, okay, we will make your borrowing costs prohibitively expensive until you back down.
That is exactly the market mechanism. Bond market turmoil makes that refinancing exercise far more expensive and difficult, and it could potentially lead to a fiscal crisis. It forces the administration to weigh the political benefit of a dovish chair against the immediate, tangible cost of exploding interest payments on the national debt.
The sheer volume of U.S. debt ensures the market's voice is heard immediately.
It acts as a powerful, nonpartisan force policing U.S. institutional integrity.
It's fascinating that the global financial system is, in effect, policing U.S. political stability. But let's shift our focus now from Washington back to Asia, because this entire political drama is paralyzing one specific currency pair we started with, USDSGD. It's stuck right around that 1.3011 level.
And this is a textbook example of a currency at a crossroads. The USDSGD is in a phase that traders call consolidation, and this one is highly charged. The pair is essentially reflecting the structural tension between the politically weakening US dollar and the policy-rigid Singapore dollar.
Define that for us in more depth. What exactly is consolidation in Forex trading, and why does it matter beyond just being a quiet period in the market?
Consolidation is a phase of market hesitation or freezing. It typically occurs after a strong, bullish, or bearish trend. Critically, it's defined by market participants being unsure of their collective strength.
So buyers and sellers are in a stalemate.
A stalemate, an equilibrium, an information impasse. The price is unable to reach new significant highs or new significant lows. But it matters deeply because consolidation is a period where institutional liquidity accumulates.
What does that mean, liquidity accumulates?
It means the large players, the big banks and funds, they aren't exiting the market. They're simply waiting on the sidelines for a clear signal before they commit large amounts of capital to a new direction. So the price compresses, liquidity builds up beneath the surface, and this phase is usually followed by a sharp breakout.
Like a coiled spring.
Exactly like a coiled spring. A violent move that resolves the tension and pushes the price significantly in one direction.
So how do we know this isn't just a quiet holiday trading day, but rather this charged wait-and-see phase driven by political fear? What are the specific technical signals that confirm USDSGD is accumulating this tension?
Well, traders rely on three primary technical indicators to confirm a true consolidation phase. The first is volatility compression, which we can measure using Bollinger Bands.
Okay, what are Bollinger Bands?
If you look at a chart with them on, they will appear as two bands, or lines, above and below a moving average. They are based on standard deviation, which is just a measure of how far the price typically moves away from its average.
And what do they show us here?
When the bands are flat and visibly narrowing, squeezing together, it means the market is trading within a much smaller range than usual. It's a signal of a dramatic decrease in volatility. And this low volatility environment is actually very attractive to institutional players who want to build their positions quietly before the political explosion.
Okay, so that's signal one, narrowing Bollinger Bands. What's the second signal?
The second is the average directional index, or ADX. This indicator measures the strength of a trend, not its direction. During consolidation, the ADX falls sharply and settles below the critical threshold of 20.
And what does a reading below 20 tell you?
An ADX reading below 20 signifies a definite lack of trend strength. The market is neither definitively bullish nor bearish. It confirms that directional indecision.
And the third signal?
And the third signal is the Relative Strength Index, or RSI. The RSI measures the speed and change of price movements. During consolidation, the RSI hovers perfectly near the 50 mark. A reading near 50 shows no clear directional bias. It's neither overbought, which is above 70, nor oversold, below 30. The lack of momentum across multiple timeframes reinforces that psychological balance between buyers and sellers.
It sounds like all these indicators are basically saying the same thing. The price is just getting squeezed into a tighter and tighter box.
That's the classic visual analogy, the compression. On the chart, you see lower highs and higher lows geometrically compressing the price into what looks like a triangle pattern. This narrowing pattern is a powerful sign that an imminent breakout is coming. The market is just running out of room to move within its established boundaries.
And the longer it stays in that box,
the higher the probability of a major violent breakout when the political news finally hits.
Let's discuss the immediate technical context here. If the pair was recently trading higher, say around 1.3435, and now it's consolidating down near 1.30 was, what technical levels is the market watching for a potential resolution of this standoff?
Well, the current consolidation suggests a slight bearish momentum because it's happening after that recent drop from the 1.34 level. However, the price is taking directional cues from two major external drivers that are basically fighting each other.
What are those drivers?
The first is that U.S. dollar volatility due to the Fed uncertainty, which is pulling it lower. But the second is the complex flow of the Chinese yuan. The USD-CNH pair has been grinding lower, which influences the entire Asian FX basket, including the Singapore dollar.
So if the yuan is strengthening against the dollar, it creates momentum for the SGD to follow suit.
It does. It adds to the downward pressure. So the currency is being pulled down by U.S. dovishness and also pushed down by this broader Asian momentum.
So what are the key levels traders are watching?
On the downside, the critical support level is identified at 1.3340. This level is crucial because it aligns with two major technical metrics: the 200-day moving average, a key long-term trend indicator, and also the 23.6% Fibonacci retracement level of the recent move.
So a very strong floor.
A very strong technical floor. If a Hassett nomination breaks that level, the next target is down at 1.3240, the next FIBO level. On the upside, resistance is sitting at 1.3460 and 1.3490. A breakout beyond those bands will confirm the market's direction once this Fed drama finally resolves itself.
Now let's really focus on the Singapore side of the pair. If the US dollar weakens substantially because of this potential dovish Hassett Fed, that means the Singapore dollar, the SGD, strengthens relative to the USD. What are the macroeconomic implications for a small, trade-dependent nation like Singapore?
This is where the local pain begins, really. It comes in the form of what we call the silent squeeze, particularly on Singapore's very important export sector.
The silent squeeze.
Yes, and to understand this, we have to look at Singapore's unique monetary policy framework. Unlike almost every other central bank in the world, the Monetary Authority of Singapore, the MAS, does not target a specific interest rate.
What do they target instead?
They manage the value of the Singapore dollar against a trade-weighted basket of currencies of its major trading partners. This is known as the S-dollar nearer, or the Singapore dollar nominal effective exchange rate.
And why do they manage the currency value instead of the interest rate, like the Fed or the ECB?
Their primary mandate is to combat inflation, which is a massive challenge for a country that has to import almost everything: food, energy, consumer goods. A strong, stable, and gradually appreciating Singapore dollar makes all those imports cheaper, which is critical for price stability.
So a strong currency is their main weapon against inflation.
It is. The SNIR itself is not a public number, but the MAS manages it within a target policy band. Recently, the SNIR was observed to be about 1.08% above its model implied midpoint. That's a very tight reading, and it suggests the MAS has been actively allowing or even encouraging the SGD to remain strong to fight those inflationary pressures.
So what happens when the US dollar suddenly weakens due to these political factors?
The MAS is placed in an immediate dilemma. They either have to intervene heavily in the currency markets to prevent the SGD from appreciating too quickly, or they risk throttling their own export economy.
You mentioned the silent squeeze on exporters. Let's look at the human and the business cost of that policy rigidity. Can you give us a concrete example of how this affects a typical Singaporean business?
Yeah, let's take a mid-sized precision engineering firm, say in the Jurong industrial estate. Imagine they specialize in making highly complex components for multinational tech companies based in the US.
Okay.
This firm has all of its fixed costs in Singapore. They pay their local staff, they rent their factory space, and they incur operational costs entirely in Singapore dollars, SGD.
But their customers pay them in US dollars.
Exactly. They receive their revenue in US dollars. So when the US dollar weakens, let's say it drops 5% against the SGD due to anticipated Hassett-driven rate cuts, that exporter still receives $1, but upon conversion, that $1 translates into 5% fewer Singapore dollars than it did before the political storm.
So their revenue stream has just shrunk by 5%, even though their sales volume, their staff costs, and their utility bills haven't changed at all.
Precisely. It's a direct contraction of their profit margins purely due to the exchange rate. If this firm was operating on a tight 8% margin to begin with, a 5% currency loss represents a catastrophic drop in profitability. It's a severe impact on their bottom line without any corresponding drop in sales volume or quality.
And the dilemma for them is that they can't just raise their prices to compensate for the currency squeeze, can they?
That's the critical constraint. They operate in a highly competitive global market. They can't just raise their prices in US dollars by 5% because they risk losing that business to competitors elsewhere in Asia, say, in Vietnam or Malaysia, countries that might have weaker or more stable currencies.
So their prices are set by the global market, but their costs are set locally.
Their pricing power is dictated by global competition, while their cost base is fixed by a strong local monetary policy. This creates an extremely delicate balancing act for the MAS. They have to maintain a strong SGD to protect consumers from inflation, which is a political necessity. But this very policy places a heavy, silent burden on the manufacturing and export sector.
And the consequences are very real for these firms.
Very real. We're talking deferred capital expenditure, hiring freezes, and in the worst-case scenario, restructuring or even business failure, all stemming from a political decision made thousands of miles away in Washington.
The USDSGD pair, stuck at 1.3012, is truly a direct reflection of this tension then. The U.S. side is being pulled lower by the expectation of politically motivated rate cuts, and the Singapore side is being held artificially firm by a monetary policy designed to fight local inflation and maintain institutional stability.
The resulting paralysis is structural tension made visible on a price chart.
That's the high-stakes silence we discussed earlier. It's a moment of structural conflict. U.S. political instability versus Singaporean policy rigidity.
Exactly.
Since the market is static but the political risk is explosive, how are professional traders managing this right now? If the price isn't moving, how do they protect themselves against a huge move that can happen in milliseconds? What financial tools are they using to hedge against this binary political event, Hassett in versus Powell stays?
When you're faced with a binary event, a clear up or down outcome, and when the current low volatility feels fundamentally fake and temporary, traders overwhelmingly turn to derivatives. Specifically, they employ a highly effective defensive strategy known as a straddle in options trading.
A straddle sounds aggressive, like you're betting on movement.
Yeah.
But you're labeling it as defensive insurance. How does that work in practice?
Well, a straddle involves simultaneously buying both a call option and a put option at the same strike price. They're often slightly out of the money and with the same expiration date, which aligns just after the expected announcement.
So what's an option in this context?
An option is essentially an expensive insurance policy. It's a contract that pays out if the market moves violently in either direction.
How does that work?
If Hassett is nominated and the dollar crashes, the put option, which is the right to sell at a certain price, pays out handsomely. If, conversely, Powell is confirmed to stay or the nomination is delayed and the dollar strengthens due to market relief, then the call option, the right to buy, pays out.
So the trader is paying the premium for both sides of the trade. They know they'll lose that premium if the market just sits still, but they are protected against massive swings either way. What is the key driver of the cost of this straddle?
The cost is driven entirely by something called implied volatility, or 4M. Implied volatility is the market's expectation of how much the price will move in the future.
So it's a measure of fear, in a way?
It's a measure of expected future fireworks. As we approach this potential Christmas announcement, traders buying these straddles are driving up the IV of short-dated USDSGD options. They are willing to pay a much higher premium, more expensive insurance because they know that when the political news finally breaks, this wait-and-see phase will end and the realized volatility will explode.
Justifying the cost of that protection almost instantly.
Exactly. The fact that straddles are being purchased so aggressively in the options market is the most tangible evidence of the anxiety we are discussing. It proves that the current low-price volatility does not reflect low risk. It reflects high, unresolvable political uncertainty.
That perfectly captures the anxiety. So, beyond pure defense, let's look at the active trading strategies that are employed during consolidation. You mentioned there are two main strategies. Let's start with the one that's optimized for anticipating the coming volatility, the resolution of this political crisis.
That would be breakout trading. This strategy is built entirely on patience and anticipation. Traders must first define that consolidation zone using the indicators we discussed, the flat Bollinger Bands, the ADX below 20, and the low volume. The core principle here is patience. You do not enter until the price breaks cleanly out of the established range.
So you're waiting for the market to signal its direction first. What confirms a true breakout versus a false breakout? Because those false breakouts, where the price briefly exits the range only to snap right back, are lethal to traders.
They are indeed. The filter is crucial. You need two pieces of confirmation, a volume spike and a full candle close outside the range boundary.
Can you walk us through that?
Sure. So, for example, if USDSGD is consolidating between 1.33 and 1.34 for a long position, you wait for a full candlestick, the entire body of the candle, to close above the 1.34 resistance level. This helps filter out those whipsaws or false breakouts. The volume spike is the second signal. It indicates that large institutional money is now committed to the new direction.
And since this is such a politically driven event, successful breakout traders must be linking their technical setups to the economic calendar. What specific news releases are they watching right now to predict the catalyst for that volatility?
They are looking for economic data that could either reinforce the dovish Hassett narrative, making a rate cut more likely, or conversely, data that would make the Fed's current stance untenable.
What kind of data?
Specifically, they are watching expectations for the ADP jobs release. The market anticipates this number to soften significantly, perhaps falling toward the 10,000 to 20,000 range. A surprisingly weak ADP number would provide immediate justification for a radical dovish shift and would trigger a rapid breakout of the USDSGD to the downside, meaning a stronger SGD.
Any other key data points?
They're also watching the employment component figure of the ISM services report, which has been hovering in contractionary territory. Any confirmed sign of labor market weakness reinforces the political argument for aggressive stimulus.
What about risk management for these breakout traders? Where should they place their stop losses to filter out those inevitable false moves?
Risk management is non-negotiable here. Stop losses must be placed inside the old consolidation range. The rationale is simple. If the breakout is genuine, the price should never return to the level it just exited.
So if it does, the trade was wrong.
Immediately. For a buy trade that breaks resistance, the stop loss is typically placed just below the last low of the range. This ensures the price has sufficient space to move, but it immediately cuts losses if the move fails and retreats back into that consolidation zone.
Now for the second strategy, the one focused on capitalizing on the current stillness rather than the future volatility. This seems, well, it seems counterintuitive given the explosiveness we've discussed.
It is, and it's much riskier. That strategy is mean reversion inside the range, often just called range trading. This strategy involves betting against the edges of the range.
How does that work?
The goal is simple. You buy near support and you sell near resistance. You're essentially buying low and selling high, expecting the price to return to the middle, the mean. This strategy works best during periods of genuine low news flow where the market is truly directionless.
But if volatility is anticipated, why would any experienced trader risk a mean reversion strategy when a massive breakout could happen at any second?
They do so only very selectively and with very strict rules. They might use it tactically during Asian trading hours when U.S. political influence is minimal, or if they believe the political announcement is still several weeks away. The risk management here is absolutely paramount because one rogue headline can wipe out a position instantly.
So what are they looking for at the edges of the range?
They must look for specific bounce signals at the support or resistance levels. They're not entering a trade simply because the price touches a line on the chart. They are waiting for confirmation that the line has held.
What are those specific bounce signals? Can you give us the detailed mechanics of how they confirm that reversal?
Of course. They are looking for specific candlestick patterns that signal a definite reversal of sentiment right at that boundary. The most common include the pin bar, which is a candle with a very long wick that bounces cleanly off the level, showing a rejection of that price extreme.
Okay, a pin bar. What else?
Or the engulfing candle, where the current candle's body completely covers the body of the previous one in the opposite direction. This indicates a very strong reversal in momentum. And critically, they wait for that bounce candle to close before they enter the trade. No front running.
And risk management for this strategy?
For mean reversion, position sizes are kept deliberately smaller than in breakout trading. The stops are very tight placed just outside the range boundary because they are exploiting short-term oscillations. And crucially, mean reversion requires clear, repeated touches of the boundaries, ideally 3 or more times in both directions, to ensure the range is well-defined and that decisions aren't based on guesswork. If the range looks messy, they stand aside. They'll prefer the patience required for the breakout strategy.
The difference between those two strategies really highlights the fundamental market tension we are seeing in USDSGD. One group is betting on the event, the political storm, while the other is cautiously trying to exploit the temporary hesitation caused by that storm.
Exactly. It's not a moment of rest. It's a pause while liquidity is accumulating. The market structure, the compression of price and volatility, is just setting the stage for a violent, definitive move.
So what does this all mean for us? We started with the suspicious calm of the USDSGD pair at 1.301, and we have traced that stillness all the way back to the unprecedented convergence of political interference in U.S. monetary policy.
It's a direct line.
We have a potential regime change at the Fed, this Hassett Trade, promising aggressive dovishness, and the immediate quantifiable threat it poses to Asian financial stability, specifically through the SGD exchange rate and that silent squeeze on Singaporean exporters.
The central lesson here is that the market's current apparent calm is purely accumulated tension. Everyone is just waiting for a definitive political announcement that will determine the direction of the U.S. dollar and, consequently, global capital flows.
It's a global ripple effect.
The threat of political influence compromising institutional credibility has real, immediate economic consequences. And it manifests as everything from inflation forecasts rising sharply by 11 percentage points to those Singaporean engineering firms facing margin collapse.
We established that the market acts as the immediate check on the executive branch, signaling its fears through volatility and higher long-end yields, especially given the U.S. debt rollover needs. But if this challenge to U.S. institutional credibility continues, if the market has to constantly price in political risk to the Fed, what is the lasting impact on global investment beyond just the immediate currency trade?
I think the increasing challenges to the U.S. and the credibility of its institutions are pushing investors globally to fundamentally reassess U.S. exceptionalism.
What do you mean by that?
For decades, the U.S. dollar and U.S. treasuries were considered the unquestioned global risk-free asset, the ultimate safe haven. When you introduce political uncertainty directly into the core independent institution, the central bank, that status is undermined.
It's no longer risk-free.
Exactly. So for long-term capital allocators, the focus shifts from whether to make tactical short-term changes in currency exposure to recognizing that global diversification is becoming a structural requirement, not just a tactical choice.
It's a permanent shift in strategy.
It has to be. Investors will actively seek alternative safe haven currencies, robust commodity strategies, and assets tied to economies with clearer, more predictable policy frameworks. This will push global capital flows away from the dollar in a sustained way. The market is shifting its view of U.S. assets from risk-free to politically sensitive.